Hi, my name is Alex Dolphin and welcome back to another episode of Ex Ante. Today we're going to discuss the question of whether the SEC or federal courts will classify digital assets securities under the United States securities laws. So digital assets, when we talk about this asset class, we're referring to cryptocurrencies, stablecoins, NFTs, DAO tokens, DeFi tokens, and the like. So let's just go ahead and jump into this. So why does it matter? Well, this question is of great significance. If the SEC classifies digital assets securities, it's going to be very costly for digital assets to continue to exist. So under the Securities Act of 1933, there's a requirement that anyone who is selling securities must either, one, register with the SEC, or two, sell pursuant to an exemption. So registration with the SEC looks generally like an IPO. This is a very expensive process where you're going to have to give tons of documents to the SEC and therefore to the public. And these documents are going to describe the business, discuss the balance sheet, what the business is planning on doing in the future, and the like. It's a very expensive process. It's going to involve investment bankers. It's going to involve lawyers and lots of transaction fees. So it could be very, very expensive, like I said. That's a big downside for digital asset creators that are trying to bootstrap projects into existence and want to access public markets for liquidity. Second, you have the option of selling subject to private placement exemption. Under Regulation D, Rule 506 allows you to sell equity in a private company subject to this exemption, meaning you don't have to do an IPO, you don't have to register your securities with the SEC. What that looks like, though, is you're generally only going to be able to sell to accredited investors, and you're generally not going to be able to solicit investments. That means you can't market. You can't be like, hey, come invest in Dolphin token. You know, that's a no-go. You're going to lose your exemption. You have to register. It's going to be a very costly process. If you violate this as an issuer, then you're going to be subject to a right of rescission. So purchasers can say, hey, I want my money back. Or they could sue you, and the issuers could be liable for monetary damages. This question is very important for that reason, because we have great significance on the development of digital assets. So let's go ahead and jump into the Howey Test. The Howey Test is a test that the Supreme Court gave the public when it's defining what an investment contract is. So the Securities Act of 1933 says a security is a stock, bond, ... investment contract. Unfortunately, Congress didn't define what investment contract meant. So the Supreme Court was forced to do that in Howey. And the Supreme Court's definition of investment contract is a three-pronged test. It's any contract, transaction, or scheme involving an investment of money in a common enterprise with a reasonable expectation of profits from the efforts of others. So a 3 or 4, depending on if you break that third prong up, test, where this is where we're going to determine this thing looks like an investment contract, therefore it's a security, therefore you either have to register or be subject to an exemption. So the Howey Test has been around for a long time. That was a case about orange groves in the 20th century, early 20th century. But the Howey Test has withstood the test of time, and it still exists today. The SEC uses the Howey Test when it determines whether novel transactions or schemes, like digital assets, are going to be classified securities under the securities laws. So in 2019, the SEC issued a digital asset framework. This is a non-binding piece of administrative guidance, but what it was meant to do is give people a little bit of insight into the SEC's process and what it will analyze when it's determining whether or not any given digital asset is going to be an investment contract and hence a security. So in this piece of guidance, the SEC basically says, the investment of money prong is almost always going to be satisfied. So we're almost always going to check that box. That one's not going to be an issue with digital assets. The SEC says, if you work for the asset, even if you really kind of just get the asset for free in an airdrop, we're going to classify that as an investment of money. So you see a very broad definition of investment of money, and that's not really where the debate is going to be. At least that's how the SEC sees it. And then second, they say the common enterprise prong of the Howey Test is almost always satisfied as well with digital assets. That's because investors or the purchasers' fortunes are always going to be tied up with one another in a network, a blockchain, DeFi protocol. One of these things, it's a common enterprise because it involves many people to sustain this network. This blockchain is not dependent upon a single individual, it's going to depend on lots. And because all those net worths are tied up, there's a common enterprise. So the SEC says what's going to chiefly consider, and the main issue in analyzing whether any given digital asset is a security, is whether purchasers have a reasonable expectation of profits derived from the efforts of others. So let's just start with the reasonable expectation of profits. And if you look through the piece of administrative guidance, you'll see there's a lot of factors. But I think what I've boiled it down to is 3 key factors here. The SEC is going to look at the marketing of the digital asset. Is the digital asset marketed as an investment opportunity or an opportunity whereby purchasers could realize economic gain through future revenue streams, royalties, and the like? Is it marketed as an investment where investors are going to get money in return? Second, do purchasers actually have the ability to realize economic gain? So that might mean if you can buy something, hold it, the price goes up and you can sell it, that's economic gain. So something just that simple. A token where you couldn't sell it and there was no ability to realize economic gain, yeah, probably not looking at a security there. And the SEC is going to look at the correlation between the purchase price of the digital asset and the goods or services that can be acquired in return for the asset. So the SEC is kind of looking at seeing if there's just a mass disparity between the price of a digital asset and what it actually does or its function in the marketplace. If that makes sense. And if you have something that's completely dysfunctional but has a price that's basically sky high, the SEC is more likely to see that as a security because people are expecting profits to come. They're expecting that project to grow and develop, and they expect to profit further off of that digital asset. Let's jump into 3B. Are the expectations of profits coming from the efforts of other people? Now, for this piece of the analysis, the SEC has defined the term active participant. An active participant, or an AP, in a blockchain network is going to be someone who basically is responsible for managing the network as an individual or as a small group of developers. And if there's a small group that's basically responsible for all of the success of that network, well, then the SEC is going to view it as you are reasonably relying on that small group or that individual to bring profits for the investors. And so a few things to think about is the project fully functional at the time of the asset sale? SEC is going to look at that, because if it's not, then you're probably, as an investor, relying on the efforts of active participants to develop that network, especially if it's a very small group. Second, are the AP's efforts managerial or ministerial? That meaning, does the AP get to decide the fate of the protocol? Does the AP get to make, the decision of whether or not to fork a blockchain? Things like this, things that are essentially managerial, or are they kind of just overseeing the function, like overseeing the voting process in a DAO? And then how centralized are the token holdings in the network? This matters because if one individual holds a majority of the tokens in a network, that individual is likely to have more control and is able to steer the network, especially if you have a DAO, for instance, where one person could unilaterally control the DAO. So those are a few sub-factors to consider in whether someone's relying on the efforts of others in a digital asset purchase. So let's go ahead and jump into some specifics. We'll start with Bitcoin. So according to the current SEC, the current commission says Bitcoin is a commodity, not a security, meaning that under the guidance that the SEC issued in 2019, Bitcoin is not a security. It doesn't need to register with the SEC. Few reasons. Bitcoin network is fully functional. No one's, there's not one individual that still is developing it and growing the network. No, it's fully functional. It's not changing significantly. The Bitcoin network does not rely on a single entity. There's not one person or one small group of people that is maintaining the Bitcoin network. No, it's truly decentralized. And then the price of Bitcoin is impacted by demand rather than the efforts of others. And that way, Bitcoin looks a lot more like a actual commodity, like gold, because it's just supply and demand impacting the value of Bitcoin, not someone else that's actually driving and propelling the network forward to growth. So that's Bitcoin. Nice picture of Gary Gensler there. Ethereum. Here's our friend Vitalik. According to the current SEC, Ethereum may be a security. So this one's kind of gone back and forth. There's been a few commissioners that have said, no, Ethereum is now decentralized to the point where, yeah, there was an ICO, yeah, Vitalik and a core group of devs, they held most of the tokens, but now it's decentralized, right? So ETH is decentralized, and this is no longer a security, even if it might once have been. But the current SEC, especially Chairman Gensler, has left Ethereum out of those discussions. He's treated Bitcoin individually as a commodity and has not treated Ethereum as a commodity, while others, especially those in the Congress, have discussed maybe treating Ethereum like a commodity, like Bitcoin. But this one is a gray area right now. So a few things to consider. Are Ethereum purchasers relying on the efforts of a small group of developers? Is the group of developers that's working on the merge small enough to qualify as an active participant in the eyes of the SEC or a federal court? Question that remains to be answered. Are they relying on the efforts of those managing the staking pools post-merge? Those that are holding large quantities of Ethereum and performing the validation services. Is the network still developing? Well, we've seen the fork after the DAO hack where we have Ethereum and Ethereum Classic. Now we see the merge coming. Ethereum continues to develop. It continues to be driven by a group of developers. It's just, is that group of developers small enough and close-knit enough to be considered an active participant in the Ethereum network? And that's a question that remains to be seen. It's also worth noting, like I said, that some SEC commissioners think that, yeah, it's decentralized enough. This is no longer a security, even if it once was, through an ICO sale. All right, stablecoins. So stablecoins are digital assets that are pegged to the value of something, whether that be a US dollar, another currency, or another commodity. Stablecoins, are those securities? Well, they might be under the Howey Test and under the SEC's administrative guidance. It's especially likely for a stablecoin to be classified as security if its management is centralized in a small group of individuals, again, constituting an AP in that network, or as Chairman Gensler has said, if a stablecoin is pegged to another item that would be a security, well, then it walks like a duck, it quacks like a duck, it's a security. But I think one of the points of debate here is, how do you profit off a stablecoin, right? It's meant to be stable. Well, there are some price fluctuations in stablecoins, some greater than others, see Luna, see Terra, but arbitrage is still a potential. Like you'll see stablecoins have swung from $1.03 to $1.06, and yeah, you can make profits off swing trading that. And then some algorithmic stablecoins need to ramp up, meaning they start at a lower price and they ramp up to the stablecoin price. And so in that ramp up period, you could also make profits. So again, gray area. And I think that's a theme that you'll see throughout the rest of this video. As we're almost halfway through it, is that this is a very just gray area. There's not a lot of answers here. It's kind of like looking into the crystal ball and trying to discern what the SEC is going to do. A moment of great kind of uncertainty here. So tokens, DeFi tokens, DAO tokens, and the like. So these tokens begin to look a little bit more like securities in the sense that they're representing ownerships over company-like structures. Now I say company-like, it's not specifically a company, as management is generally decentralized, especially in a DAO where there is no centralized management. Generally, it is truly a democratic process. But again, there's a few things to consider. If the tokens are, if the founders are still responsible for running the protocol or the DAO, and it's their efforts that are making this thing function, then yeah, we're more likely to be in security world there. Are the founders still holding a majority of the tokens, again, making them an active participant in the network, one that's capable of controlling it, one that people know is capable of controlling it? Yeah, then it's more likely that people are reasonably relying on the efforts of those founders. And then third, does the digital asset entitle holders to future economic rights or distributions? Meaning that purchasers could have a reasonable expectation of profits, talk about monetizing Uniswap and turning on fees there, potentially an area where, hey, now we're looking at a security. Okay, NFTs, non-fungible tokens. I'm not defining the asset classes specifically. I think that's beyond the scope of this video. If you're interested in that, there's great videos online. A16Z also has great resources if you're interested in reading some things. But NFTs, NFTs may be securities. Now, that's a very broad statement because NFTs are a very broad asset class. Looking at different types of NFTs, like NFTs that are used for tickets, probably no way. NFTs that are one-off artistic creations, probably no way. NFTs that are a piece of a broader NFT project, like for instance, think Bored Ape Yacht Club, think CryptoPunks, think Gary V's VFriends. Now, yeah, we're getting a little bit closer to security world. So if the NFT is marketed as an opportunity to invest in an NFT founder, then the SEC is going to be more likely to classify that NFT as security, right? This SEC is going to look at the marketing of an asset, and if an asset is marketed as an investment opportunity, well, then it's more likely to be classified as security. You'll see this as people saying, NFTs are opportunities to invest in musicians. It's like, that is great. That's a really cool thing that NFTs potentially do. But the downside of that is now we're looking more and more like securities. Is there a centralized actor responsible for marketing and developing the NFT project after the NFTs are sold? So here I have a logo of Yuga Labs. That's a real possibility that Yuga Labs is an AP as a centralized manager of the Bored Ape Yacht Club, Meebits, and CryptoPunks, right? And specifically, I'm just going to jump to 4. If the NFTs are the basis for future economic rights, right? So you look at all the holders of Bored Ape Yacht Club, they got ApeCoin distributions. They also got Bored Ape Kennel Club NFTs for free, meaning that these holders monetize their NFTs. They were able to get a stream of revenue there. And so that begins to look like, well, the purchasers of these NFTs had an expectation that Yuga Labs was going to create more NFTs in the future, issue them, and then, profit off these NFTs. So any type of action by a centralized promoter, manager of an NFT project is going to make it look more and more like a security. It's also true if the issuer of the NFT promises future utility, saying, hey, you buy this NFT and in the future you'll get access to this conference, or in the future you'll get access to this Discord, in the future you'll get access to this newsletter. Again, this looks like there's going to be someone that's enhancing the value of that NFT and is going to make it more and more valuable to others, be those through real world perks like conferences, newsletters, and like. And now people are more reasonably expecting to profit. So NFT is definitely another gray area there. And so I just want to sum up with, the debate. So we are coming full circle from why does this matter? Well, you have a very avid Chairman Gensler there on the left and a very stoic looking Mark Andreessen on the right. And just to pick these two figures to personify kind of what's going on here. You have Chairman Gensler who's like, look at all these people that have lost all this money in the crypto markets. People are essentially circumventing the SEC's registration requirements by issuing digital assets. And because they're doing so, a lot of people, a lot of grifters are making a lot of money. A lot of folks are losing a lot of money. And that could be totally problematic for those that are, invested in crypto at the top in fall of 2021. And we've seen people lose a lot of money. We also saw that in the blow up of Terra and Luna. We saw that in the blow up of Celsius. We've seen this time and time again now. And you can see when people are starting to lose tons and tons of money, billions of dollars of wealth are destroyed. You have the chairman of the SEC saying we need to have some regulation on this to ensure that people aren't losing their money to kind of scammers online, to people that you can't figure out. And so that's a very cynical view. And another way to look at that, though, is this has been the first time where, because of the SEC's registration requirements, that people have access to venture markets. Venture markets have traditionally been closed off to those high net worth individuals, accredited investors, or those in VC firms. Well, here, crypto allows, the average person to put speculative money into basically venture assets. And so from that perspective, it looks like more egalitarian to not have the regulations. That's what some would argue as what Web3 seeks to do. Protecting innovation, just as we discussed at the top of this video, there's a lot of costs associated with the SEC's registration requirements. And a lot of digital assets just aren't going to be able to afford those. A lot of digital assets aren't going to be created. Maybe a lot of bad ones aren't going to be created. Maybe that's a good thing, but maybe a lot of good ones also aren't going to be created. And there's going to be a lack of innovation, perhaps in the United States. And then finally, just An interesting thing to think about that's kind of entered into the zeitgeist recently is there's a separation of powers argument here, in that the SEC was given authority by Congress to regulate securities, those items that the Congress in the 1930s saw as securities. Now, the Congress in the 1930s probably wasn't contemplating digital assets like Bitcoin, Ethereum, NFTs, and the like, right? And so you have this situation where did Congress actually give the authority to the SEC to regulate these? And so this is perhaps an area where we're going to see cases brought up on non-delegation grounds and more sneakily through the major questions doctrine. And that'll be interesting to follow and see if there are some separation of powers arguments here saying, you know what, Congress has to speak clearly if they want to give an agency like the SEC the ability to regulate a $1 trillion+ industry like digital assets. So thanks so much for watching. I hope you enjoyed this video. If you'd like to see more, go ahead and hit that subscribe button, and I hope you have a nice rest of your day. Bye-bye.